Hey Phil, good to be back, man. What's happening?
Back again, man. It's been a crazy time. Probably one of the most controversial pods we've had so far, man.
Yeah, it's been a wild year, and like all I'm seeing now, a lot of fear, doom and gloom in
Yeah,
the market, doom and gloom in client sentiment. Everyone's thinking the market's going to crash. So I think that's why we're on today, man.
exactly. Yeah, exactly, man. And here to show them why they're still wrong.
Yeah, yeah. Well, I think partially wrong, potentially.
Partially right,
Yeah,
of
yeah.
course.
Exactly,
Of course.
exactly. Yeah. Now we're going to cover everything today. So I know we've already spoke about our entire predictions for the year, and there's been a lot of events since 2026 unfolded. That's going to have a massive impact on the market. As we all know, we've got geopolitical tensions, we've got the RBA raising rates, and now we've got a May budget from the government where they may be making changes to CGT to negative gearing. So we're going to cover all that today. The main purpose of today's pod is to look at what our predictions are, what we think the market is going to be doing in the second half of the year. But we'll be starting with the current sentiment in the market as well.
Yeah.
So I know we've already discussed what we're kind of seeing top level, but just to give people context here, when we came into 2026, we did predict the economy would slow down. I think there was a mindset that we've got an economy where we're not seeing it being as productive in Australia anymore. Unemployment rates were at risk of rising. Obviously, this geopolitical tension in the Middle East has kind of taken these risks to a higher level for economic weakness with oil spike, inflationary pressures. We've seen the RBA raise rates, which we didn't see happening this year, in all honesty. So what that means is there's more pressure on the consumer, and the consumer is tapping out in Australia. Consumer sentiment is like at 50-year lows today. So these are levels unseen since before like the 1970s, to be honest. So in the modern Australian consumer, we haven't been so down the market. And I'm seeing that every day, man. Like I'm talking to a lot of potential clients, I'm talking to clients, and people are scared. People are extremely scared. But we've been honestly saying from day one that unaffordable properties, unaffordable locations in Australia will be high risk.
Yeah.
And coming into this kind of environment, that's literally what we're seeing. It's a two-speed market. So we're seeing literally all price points above 1.1, 1.2, $1.3 million across every single city not performing. And at the same time, we're seeing, the right locations, the right fundamentals for growth, but affordable markets still outperforming pretty much all global asset classes today.
Yeah.
And I think that's something that's very important to highlight. But we literally haven't bought a property over $900,000 over the last 3 years for that same reason, just to de-risk clients' portfolios. That's what we want to do. We don't want to take high risk. And I don't want to be, too negative on people who have a negative mindset today, but just to give you examples, man, like we talk about this every day, we're talking offline, but I think everything that we put out from a social perspective, Insta, Twitter, look at LinkedIn, it's always backed by data.
Yeah.
And the sentiment is so negative, people are now literally making up like conclusions and stories in their mind as to,
Yeah.
hey, this market is going to crash any minute. The
Yeah.
latest thing I've seen this week, and I just want to talk about this very quickly because it gives you insight into the incentive, sorry, the mindset of the everyday Australian today. They are saying there's no housing shortage. They're saying that there's actually an abundance of properties. There's a mindset in the market today. Australians are saying there's an abundance of properties, and it's actually investors just buying up all these properties. And basically, homeowners can't buy properties anymore because investors have bought everything, and there's tons of vacant properties across the country. There's a specific like mindset going, the perception in some of the market that's thinking the property market will crash because it's all investor focused, no owner occupiers can get in. And every
Yeah.
time I've seen someone reply to me with these kind of comments, I'm thinking like that makes no sense to me because if we saw investors dominating this market today, if we saw only investors being able to buy, vacancy rates wouldn't be at record lows.
Yep.
You wouldn't see rental prices soaring.
Yep.
That wouldn't be the case. So every time I come back with that argument to any of these comments or any of these negative feedbacks that I'm getting when I'm talking about housing shortage, there's still the right fundamentals for growth. People have stopped replying, but I don't know. Like I'm going to read a comment out live to you. So just a few days ago, I was talking to someone, just having a friendly chat on LinkedIn about is there a housing shortage? They're of the opinion that again, investors are buying up all the stock. There's vacancy rates everywhere. I used SQM research to showcase that we're record low vacancy rates, and word for word, literally all I'm seeing as a reply is go and look at the lights that are on at night. Apparently,
Crazy.
there's no lights on a night, so there has to be
That means
properties
it's
vacant
empty.
everywhere.
Yeah,
So
it
like
must be.
we're it's not something against this person, but it gives you an insight into the mindset of the everyday Australian today. They're
Yeah.
they're very fearful. They think the market will crash. But
Yeah.
just to highlight again, with the fundamentals for growth we have, with extremely low supply, strong demand in the right locations, as long as the market's affordable, that's still doing really well. That affordable segment of the market is still growing. So when you hear or when you see or hear like the top level median price points across each city, flat, negative growth, that doesn't go down to suburb level. Just because I'm bullish on certain locations doesn't mean I can't be bearish on certain other suburbs as well. So remember, two-speed markets means that the market will perform in different directions depending on the right fundamentals. So there'll be maybe half the market that does decline this year, but the other half of the market will be doing really well. And it's just about making sure you're in the right position. You understand what suburbs, what locations will have the best chance to grow, so you don't miss out. Because ultimately, if you look at the fundamentals for Australian property, even in today's environment, in my opinion, it's still stronger than like pretty much all other asset classes, man. But what have you been seeing? I know I just kind of went on a
Uh,
rant, but it's just crazy
yeah, no,
negative sentiment. Yeah.
yeah, I'm really feeling the same thing and seeing the same thing, right? And like you said, the no lights on at night, like how really crazy that statement is because I have a client building a house in the Central Coast area and a granny flat.
Yep.
There's been three tradesmen that have worked on the property that have offered to rent out the property because they can't find anything,
Correct. Yep.
right? And the market is just so desperate right now from a rental perspective that it needs actually more properties and more investors. Now,
Yep.
they say that, oh, okay, we can just build more houses and, we've got an unlimited supply, like the sentiment that some people are sharing. But, 2 months ago, they were saying we don't have enough builders and we need people coming from overseas to build us houses. So a lot of these things don't really relate to each other. And a lot of the times the market is stagnant, like you are saying, but for the wrong reasons, not because, the house market is crashing. It's because people have the money and they're waiting. And people want to know what's going to happen and if there's rates that are, because we have investors and people buying their own property that are unsure of where to buy because they think something's going to happen. Whereas some properties in some areas, like you said, we are bearish on them. They will probably not do very well. Maybe your $30 million house is going to be worth 29, but this is not people that we should be even considering and focusing on. The ones
Correct.
that are affordable are consistently the most competitive. And especially being in Sydney, if you go further out from Sydney, even these regional towns outside of Sydney, they're seeing the best growth that they've ever seen. There are certain pockets that were overinflated, right? And to use a quote that I saw, some people just pay for value, but that doesn't mean that's what it's worth. And
Mhm.
some people did overpay, but I'm sure you can agree with me. Most of our clients, if not all of them, actually grew their properties at least 10% over the last 3 years, regardless of what's been happening in the market.
Yeah, man.
Whether that was a COVID crash, even though some places did go down,
Mhm.
we can confidently say that our clients all did well.
Yep. Exactly. And you mentioned two types of people. You've got people with money, they're ready to buy, or people that are just scared of getting to the market. Now, I don't think everyone does have the money to buy today, in all honesty. Like the property market, honestly, has always been unaffordable for most. That's just the harsh
Yeah,
truth. We've never
yeah,
seen any real estate market across the developed world being affordable for the majority of the population. That's
yeah,
always been the harsh truth. But what happens right now, anyone with money, if, for example, you're waiting, it's perfectly fine if you're waiting for an unaffordable location that is likely to correct. But let's say, for example, you're staying on the sidelines and you've got even a location compounding at Australian average 5% a year. The way that inflation is going to rise itself at this point of time, your money is losing value as you're sitting on the sidelines.
yeah,
These properties are still growing in value. And if you wait until market sentiment improves, which means maybe the economy is like weakening more and RBA might be wanting to cut rates, maybe there's lower supply of homes, but once the market sentiment shifts, then all of a sudden you're paying more premium to get into the market that you've been waiting on anyway, while your
mhm,
money is declining value.
yeah,
I think that's a very important point to highlight here. I'm not trying to create FOMO and say, you need to go and buy property today. But if it makes sense for you, this asset class, and you've done your research and you've consulted with the right people, if you're buying the right locations, there's no point in waiting because the fundamentals for growth are so strong today
yeah,
because they have no supply of homes, a lot of population coming in, despite whatever rates do or whatever inflation does, property is a hedge against all that stuff.
yeah,
So the longer you wait, in an inflationary environment, your money is going backwards when most likely property is outgrowing whatever you're trying to save or whatever event you're waiting for. And to be completely honest, man, like I've been having a few talks with a lot of people today. Unemployment will rise over the next few years. So there's two types of assets, in my opinion. There's the asset of buying the property, so the property itself is an asset, but the other asset is getting lending.
Yeah.
Being able to get lending is an asset itself because you won't always have the income to support a loan from the bank. AI might be taking jobs. Unemployment rates might be rising because the economy is weakening in the background. Is your job safe? So if you have income coming today and you can get a loan, you've got some savings to buy property, hardly consider that because you don't know how long you have a lending for. But once you've got in and you've got the leverage from the banks, you're leveraging your money 6, 7x in the market. That's at least compounding 5% a year if you're buying the right location, at least 5% a year. I'm
Yeah.
not even talking about outperforming right now, but
Yeah.
at least you're then keeping up with inflation and more. So
And that, yeah, and that 5%, oh, sorry, cut you off, go ahead.
no, I was just saying like this the mindset needs to change for
Yeah.
people that are looking at it in the complete wrong way because honestly, locations like Mossman, Vaucluse, Kirribilli, Lane Cove, Hunters Hill, like these are unaffordable locations in Sydney I'm talking about, but they will decline every few years 10 to 15%. In 2022, I was attending home opens. Properties were selling for $3 to $5 million less than the previous purchase price. Why is that? Because they're so unaffordable and they are impacted by high rates. They are.
Yeah.
But on the other
Yeah.
hand, locations that we're buying today or we're buying back then, they were growing 10 to 20% a year. So there's
Yeah.
a very big difference in all locations of the market. And you have to understand this and just make sure that if you are waiting on the sideline, understand that there comes a risk to that of not just missing out on a price point, but potentially you missing out on lending from the banks.
Mm. And to your point, right, 10 to 20% isn't an extraordinary achievement. It's not
Yeah.
something that we barely ever get. This is a consistent result that we get. And
Mm.
a conversation that I had similar to what you had with a client is, what if the rates go up once or twice? Now that's maybe a $200 to $300 difference a month. If
Right.
you're going to miss out on 10 to 20% on a whole property over a couple of $100 a month, that's when you see your losses will compound, like you said.
Yep.
And now in future, you can probably borrow even less now because the rates have gone up, because the market is more competitive and you're actually behind. Like you said, property has been the perfect hedge consistently for our clients. And whether or not you want to go as risk adverse into that is up to you, but it has to be part of the portfolio and has to be part of the strategy if you really want to kind of grow your portfolio. Whether that be, you don't have to, like you said, buy those really nice homes. You don't need to buy a $3 million house and expect it to go to seven because, of course, that's not realistic. But
Yep.
if you were to buy, like you said, under that 800 to 900K mark, something that's not unreasonable, as sad as it sounds, you're really competing against other people that are, similar to your situation, and that's how you really will grow. If you overshoot, then obviously you're going to get disappointed, you're going to get left out, you're going to feel like, wow, this is too hard, it's overwhelming, and a lot of people do give up really easily that way. But I've never heard of a client say, I wish I waited to buy this property. It's
Yeah.
always, I wish I did it sooner.
Yeah, yeah. I think we agree on this, man. I think it's just making sure you're educated. Like, I'm not
Yeah,
saying we're not here saying you buy any property in the market, you'll get the growth.
yeah,
It is a very risky time to buy property. That's there's no other way to put it. Like you're in an environment, you're in a stagflationary economy. This is coming to my next point. Stagflation means, hey, economically, we're seeing weakness.
yes,
Economic growth is declining, but the cost of goods, services, everything is increasing. So inflation's rising. Inflation should normally be rising by consumer demand. That's why prices should be going up. In this way, it's rising for different reasons while the economy is
yeah,
weakening. So stagflation environments are very dangerous. It puts the RBA in a very, very tough spot because while they're seeing inflation rise, they're not seeing economic growth.
yeah,
And right now, that's why a lot of people are scared because you've got unemployment about to rise or rising in the background. You've got the cost of everything going up, especially because oil goes into everything. Oil
yeah,
doesn't go
literally
it doesn't
everything.
go just for the petrol station and it's not just your oil that you put in your car. It's literally looking into construction
Your
costs, cost of
clothes.
materials, clothes, services, everything. So this takes time to seep into the economy. So inflation will be higher for a longer period of time. 6 to 12 months from now, inflation will still be higher than expectations.
Yeah,
That's the harsh
yeah,
truth. So
yeah,
with the RBA being in a tough spot, I understand that people are cautious, but it's just coming back to what's your money doing if you're not investing it?
exactly
Because
right.
you're losing anyway, because inflation is rising, going to be rising at 5% a year. I know for a fact most people's wages aren't going up 5% every year. And if there are, that's great. But at the same time, what's your hedge? Hard assets are
Yeah,
the best hedge. Now,
yeah,
I think again, doesn't mean all property you just put it into any asset in the country it'll grow. You've got to be doing your research, doing your due diligence, because it's never more important than today to do all the right steps, understand the numbers. You mentioned people are cautious about interest rates. 100%. But why would they be cautious? Because they're not using buffers in the calculations, not understanding the numbers
exactly.
behind the investment. To your point, if I can't afford another $200 to $500 out of pocket per month for a property that might grow 50, 60, $70,000 every single year, then that is a risk on myself, but there is growth you're missing out on. So if you're doing the numbers correctly and you understand all the finances, all the financials behind a certain investment, if it makes sense, it will be worth it. But for some
Mm,
people, it won't be worth it because they can't afford to miss out on the savings or they can't afford to hold the property. And that means
mm,
you just have to make sure you understand the numbers again. But
mm,
yeah, like overall, man, like with the stagflation environment, I also feel that from a price growth perspective, coming into what's going to happen in this next half, construction prices will keep going higher, getting
yeah,
higher. Construction prices
yeah,
will keep growing. And what that means is your floor price for all the properties across every location will consistently go higher as well. Now, does that mean that, again, unaffordable locations rise? It doesn't mean that. But in most locations, let's say, for example, the cost to build a property has on average been like 500 grand in one location for like a 4 bedroom, 5 bedroom property. And now all of a sudden that's going up 20%, 30%. Reese Plumbing just mentioned all the pipes have gone up 36% in the last 2 weeks. Now,
wow,
if your construction prices are rising 30 to 30% in the next few months, every new property coming to that location will be priced higher.
yeah,
Existing properties will have to catch up because that's a replacement cost as well. So construction prices rising over the next few months will also make property prices grow. So people have to just understand that waiting on the sidelines only makes sense if you're buying at unaffordable locations that are impacted.
yeah.
If it's most likely this location is very affordable and there's minimal supply and strong demand, you're not going to see that location decline, unfortunately, and you're just taking more risk on your side if you are looking to get into the market because you don't know how long you'll have that same income or the
Mm,
same borrowing power with the banks with the rates
mm,
today.
mm. And the more real example, to make it more like reality, these aren't just numbers that we're making up. A $4 million house in Sydney versus an 800 to $900,000 house, maybe an hour outside of Sydney, have a completely different market.
Yeah.
And interest rates impact these things completely different. Like you said, that floor is always going to go up. There's going to be less money for investors and builders and developers to buy and flip those lower and expensive homes, and they're just going to become less supply, and that's what's going to really cause the higher demand and the higher prices. So even though you might think, oh well, the big suburbs are going down, or even some suburbs that aren't very nice or maybe don't develop like they should have, that can definitely have an impact. But if you've got the right numbers, if you're by the water, if you've got the right facilities around you, good schools, there's fundamentals that just never change in human reality, and what people want, the things that people want has never changed.
Yeah, 100%. And that's why we're just focused on buying properties where people want to live.
Yeah,
If you get
it's
that
it's really
part
that easy.
right alone, you
It's that
won't lose
easy.
long term. You'll have consistent
Yeah,
growth long term at least because owner-occupied
yeah,
demand is everything. And I think this kind of ties into, what we're seeing in the second half of the year. So I think this two-speed market will continue. You personally won't be seeing us buy properties maybe over 900, 950 grand. I think that will be quite risky.
yeah,
Again, that this is all relative. So this can change any given time depending on what happens to the market, what happens to the rates. This is just statements I'm talking about at today's market. So we haven't bought a property over 900 grand in the last few years. And we've done that for a reason because we want to be focused on where we feel the market will have maximum growth, but also focus on where owner occupiers want to live. So that's
yeah,
worked out fairly well. Will that continue? Maybe, yes, that's what I'm predicting. But again, this environment can change at any given time. But that's what we're seeing today. And second half of the year, we're also going to see a lot of changes coming from the government because the May budget is coming next year. So they're
yeah,
talking about changes, and we've briefly discussed this, but they're talking about changes to capital gains tax (CGT). So basically, reducing the capital gains tax discount, and they're also talking about reducing negative gearing to a maximum of two properties only. So, in my opinion, the main issue for the housing is related to supply and demand.
yeah,
These two policies, in my opinion, seem more like a cash grab to me because the government spent a lot of money over the last few years in order to keep the economy afloat, to be honest. But they've spent a lot of money, and that's been very inflationary. And today we're seeing the average Australian pay for this. But
yeah,
if you look at these two policies, man, like capital gains tax discount reducing, we've discussed this. If I'm an investor and I'm paying more tax, number one, I feel like I've done a great job to invest and make money in the market. It's not easy to do. Not everyone does this. Only a select amount of Australians have the luxury of being able to buy investment property. And if you're trying to take more money off my profits, then where's my incentive to sell? I have less incentive to sell this property. And we live in a system where I can take out equity, I could refinance my property, get some equity, buy more properties as well. So selling this and paying more money to the government, I have less incentive. So This policy, in my opinion, is a cash grab. I think what it's actually doing is taking away supply from the market, which is very crucial because less properties being sold are less properties available in the market.
Mm.
That's a fact.
And why would I add value to properties? Why would I
Yeah,
develop properties? Why would I, maybe make a duplex, maybe make a granny flat? If I
yeah,
don't have an incentive to these things, like you said, if I have an incentive to not sell, and now the other point of negative gearing that goes to, all I'm going to do is put up rent and not sell.
correct.
So how does that really support, the market and the rent that the government's going to get from that? Is that really the tax? Is that really going to make up for, the housing shortages that we already have?
Yeah, in my opinion, it won't, and that's the main issue with these
Yeah.
policies. I don't, in theory, have an issue with these policies if we didn't have a
Yeah.
massive housing shortage and
Yeah.
we didn't have RBA raising rates in the background. But it feels like the everyday Australians pay more and more for incompetencies from the
Yeah.
government side, in my opinion. And
Yeah.
even from a negative gearing perspective, man, like limiting that to two properties. Here's a stat: like only 8% of Australians own two or more properties. So you're now
There you go.
targeting the top investors in the market, which is perfectly fine if that's who you want to target. But how does that impact housing supply? How does that
Mm,
allow housing affordability for the remaining 92% of Australians looking to buy their first home?
mm.
It's a cash
And
grab.
a lot of the times, if you've got three, four properties, a lot of these clients, their properties are positive or break even.
Yeah,
So even then, that
mine
doesn't
are even
really
the
impact them
8%.
in that way. Yeah.
100%.
So
So if I'm an investor, like if I've got then these two policies taking money out of my pocket, essentially that's what they're doing.
yeah,
My immediate response would be I need to make it back somehow.
yeah,
And what's
yeah,
more in your control? Well, keep in mind, rents, to your point, are at record low vacancy rates today. It's the tightest rental market we've seen, and rent prices are soaring. So
mm,
landlords will be pushing to increase rental prices for sure, because they're losing money from these two policies and they want to get that back. And what's one of the largest causes of inflation today? It's rental
yeah,
prices in Australia. So
yeah,
all these rate hikes the RBA is doing to lower inflation apparently this is actually very counterproductive to what the RBA is doing in the first place, because it's again not addressing housing supply, it's not addressing
exactly.
demand policies, it's only addressing your top percentile of investors and making sure the government's earning some money back. But
Mhm.
overall, it will be more inflationary for the environment, in my opinion, man. And I think as a result, what you'll see is housing supply will be, more challenged in the second half of the year because RBA is going to be more inclined to keep rates where they are, where they are, or might even raise one more time, which means again, developer funding for any new dwellings being built gets more expensive and less
Yeah,
builds go through, less people are selling properties. That means less supply available.
yeah,
And
yeah,
all the numbers show there's still like 500,000 people coming to the country today. So I don't think this supply shortage will be sorted out anytime soon. And the government's doing it to themselves. So second half of the year, the fundamentals will still remain. So our
yeah,
predictions for the more affordable range of the market doing well, they'll stay. And the
yeah,
unaffordable range of the market has the more risk. But
yeah,
these policies, yes, they will maybe cause a slight impact on investor mindset for the first 2, 3 months. But once people understand that it's not impacting the overall fundamentals of the market to grow, people are still buying,
yeah.
and there's no supply. So like this doesn't change anything theoretically.
And the crazy thing is like no matter what happens to the world, whether it's good or bad, there's so many ways where prices are still going to go up,
Yeah,
right? If we cut interest rates, then that means people that can afford more, the world around us is probably doing better. There's better sentiment, prices can go up, right? If the sentiment around the world is really bad, things go up and there's crazier wars. That means a higher costs for things and building, especially because a lot of countries would rather use that resources for war instead of building more houses, then supplies goes down, houses go up.
yeah,
So really, I don't want to work in the RBA because I wouldn't really know what to do either, right? Because they're really damned if they do, no matter what they do, right? And from a property perspective, right, as like you said, if you're buying the right place, there's really not much that's going to go wrong unless it's some once in a million extreme case, right? Because as long as the fundamentals are right, everything else around you will crash before your place will crash if it's fundamentally correct.
yeah, yeah. It's a really good point you made. And if you look back at like 40 to 50 years of Australian history, like I've mentioned this many times, in the most chaotic environments, in the global financial crisis, the maximum our property market decline was 8%. And
Yeah,
that's as a whole. That doesn't mean every suburb declined 8%.
yeah,
That means as the median price point across all locations declined 8%, but it was driven again by the more unaffordable locations on top of that.
Yes.
So will we see on the GFC? No one knows. But what we do know is that if that's the maximum drawdown and you saw like the stock market crashing 50, 60%, some stocks even crashed 90%, it's a very low risk environment here. So our
Mhm.
predictions, you mentioned something very important. I wouldn't want to be in the RBA shoes either because
Mhm.
they are stuck. And it's not only their fault, but what they're doing today by raising rates is, in my opinion, counterproductive because
Mhm.
housing is a key component to inflation.
Yeah.
And this is hurting the average Australian, but it's not fixing the housing crisis. Raising
Yeah.
rates is not doing that. So, in
Mhm.
my opinion, just like every other time in the past, when you see economic weakness, even if the inflation levels are rising, the RBA will choose to save the economy. They care about unemployment rates. They can't let
Mhm.
the economy crash like that. So our prediction for the second half of the year or coming into the next year would be they will start cutting rates in 9 to 12 months. They have to. Because if it keeps going this way, the economy will slow down significantly. Unemployment rates will rise. And
Yeah.
they have to choose to save the economy. I think we'll be in a very inflationary environment for a number of years, in my opinion.
Yeah.
What that means, by the way, is the cost of goods and services are never going back to the levels you saw a few years ago. They're just not. And unfortunately, that means, again, we've talked about this before, but the middle class will be priced out.
Yeah.
They're basically getting killed, and they will be finding it very hard to buy property,
Yeah.
very hard to invest their money, very hard to buy hard assets. At the same time, you've got AI taking jobs. So there's a whole other segment here, but our predictions are like RBA will have to cut rates at least to save the economy in the next 12 months. You'll be seeing that having more demand come to the market because they will choose to save the economy. Market will be pricing in higher inflation, yes, but that means hard assets will do better because people know the value of hard assets then, especially as
Yeah.
rates are dropping because they have to save the economy.
Yeah, yeah. And to your point, what do you think are the real hurdles? Like I personally don't think the rate is a real hurdle or stopping point for me buying a
Yep.
property,
Yep.
right? Like you said, what's going on around the world, you do have to think about it, but it's not
Yep.
going to make my decision for me. What do you think are really the biggest hurdles for your clients to actually get in the market?
I think right now, a lot of the hurdle comes from mindset, man. Like, I think
Yeah,
if I don't even talk about borrowing capacity and things of that nature, like if I'm speaking to, a few clients who are looking to understand what they can do in the market, a lot of them
mhm,
are, we talked about it in the beginning of the podcast, a lot of them are scared. They're
yeah,
not confident in the market dynamics today. They're not even confident on their own roles. I've had maybe a record number of client consultations to start off the year. And a lot of people are just waiting to get the journey started because honestly, they're even mentioning they're uncertain about their job security. And that's when I mentioned that lending is an asset. Because right now, a lot of people are working in IT spaces, accounting spaces, legal spaces, and they're scared about AI taking their jobs in the next 2 years. So
yeah,
they're even thinking it's tight for the average Australian. So they're thinking if I was to buy a property, which I want to do, will I have a job to be able to afford to hold this property? That's
yeah,
another massive part of the equation as well. So I think mindset and job security are the top two things I'm seeing that are the barriers for entering the market today. And the next thing I would say is just savings. So anyone who's ready and ready to go, unfortunately,
do it.
sometimes it comes down to cash available. You do need to
Yeah,
work hard to be able to save up for a deposit for a property. We have flexible options that we work with clients with, but that's another story. But in general, getting your first property is the most difficult because most of the times you're saving up for the deposit yourself
yeah,
in when inflation's rising today, cost of living is like, an all-time high, it's not easy to save that deposit, especially if it's under one income. So
yeah,
that's probably the next thing we're seeing is just making sure that we're working with people who are able to save their money, get the deposit ready, and then we can start full steam and get into the business of buying a property. But yeah, I think mindset comes down to everything. And then I always take a step back. So when people are talking about is it worthwhile me buying a property today, same things we're talking about in today's podcast understanding the numbers. So if you were to stay on the sidelines, what does that mean for your money? What does that mean for the money that you're keeping on the sideline? What are the
yeah,
risks of you staying on the sideline?
mhm,
Assuming the property will just do market average growth, not even
yeah,
overperform. And
yeah,
assuming that you actually keep your job and keep the same amount of income, that you can still get borrowing when the time comes that you want to enter. What are you losing?
yeah,
And the risk of you, maybe losing some income in that same time frame, or the rates rising once or twice more, which means your borrowing capacity is dropping again. There's a massive opportunity cost to staying on the sideline if you know what you're doing
mm,
and you're confident you're
mm,
buying the right
mm,
location. So
mm,
that's what I'm
mm.
seeing. What about you, man? Like, what are the
I,
barriers?
I I agree with you totally, right? And I'll give you a perfect example.
Yeah.
We've been speaking to one client since October,
Mhm.
and exactly what you said, they're ready to go. They've just had cold feet. They weren't too sure. They wanted to wait. Now, the prices and properties that they're buying, they've probably lost 50,000 in that time.
Yeah.
right? And that's not unreasonable or unrealistic, right? And now they've been turned to the complete opposite where they feel rushed. Now
Yeah.
they had all this time to plan and strategize, and now they're feeling like I got to hurry up because it's getting faster and faster and faster. And you do get into that when you start looking at the market and you're just seeing prices going up and up. And like you said, vacancy rates, listing rates, they're all historically low. I think that's the biggest thing, like you said, the psychology of buyers and also tradesmen. That's not something that we've really touched on, but
Yeah.
it's been really hard for a lot of our clients to buy new properties, build new properties, or even make repairs. Budgets get blown out of proportion, or trades don't show up and things get delayed. And I think that's been one thing that's honestly turned off some clients saying, I did profit off this, but do I really want that headache again? And it's been really hard finding, trustworthy, consistent work.
Yeah.
That's the lucky thing is, with us, I'm sure it's okay to say this, but a lot of our properties are in the Central Coast, Newcastle region right now. There is a lot of customers and attention there. Being in Sydney, we can connect with some trades there, so that's a good advantage,
Yeah.
right? Having things like that makes customers more comfortable, right? But the interstate investor that's looking at a property that looks a little bit has some issues, they might be a bit more hesitant than they previously were, just because of being able to get trades and having things organized. That's the things that I'm seeing as well as what you said.
100%. And do you think like from your client base, you get a bit of, hey, I've missed out on the market for now and I've seen prices
Mm.
rise. I know you mentioned this particular client was more rushed to get in the market, but are you seeing a lot
Mm.
of, you know what, I missed the market now. Maybe I
Mm.
should buy it because I missed my opportunity.
Yeah, yeah. And they're like, oh, well, the war's going crazy. We're probably going to get one more rate cut. I might as well wait. I'm getting a bit of that too, right? It's
Yeah,
like, okay, well, I missed that at the beginning of this year, but that's just human psychology. We're always going to kick the can down the road,
correct. Yeah.
and you're
Yeah.
always going to want to be more organized than you could have been. And that kind of happens consistently. But I do feel that a little bit more now than before, where people are either, desperate and like, oh my God, I got FOMO, or, I might as well wait since I've been waiting.
Exactly, man. Yeah. For me, like when people are very negative and they feel like they missed out, it comes back to the key fundamentals again. Australian property market today is worth like $12.6 trillion. Our stock market is worth like 3.4 trillion. Our market is the economy. Our real estate market
Yeah.
is the Australian economy today. So even if you think that this war, these conflicts, they're going to keep escalating and there's going to be a massive issue, or prices go $200, whatever you think that might happen, the worst case scenarios, whatever you think that is, there's no way that the government, they can let the Australian market crash, the property market
Yeah.
crash, because that means demise for everyone. The world's over for Australia then. So I think like this way you got to just think about it logically is number one, it's never happened, and even if all the dominoes are falling into place for this massive market crash, they will come in and stimulate the hell of the economy in that
Yeah.
scenario. So
Yeah.
yes, there will be short-term impacts, but like you shouldn't be worried about entering into a property which you can hold, which you can hold for a number of years because you've done your numbers, because over the next 5 to 10 years, you will see growth. And
Mm.
I can guarantee you in this inflationary environment, it'll do a lot better than whatever your cash is doing on the sidelines. I think that's
Yeah.
what it ultimately comes down to.
And I don't think you're being naive or overly positive. Like you said, if anything does happen to our market,
Yeah,
right, there's so many levers that the government has just to pull on to lift it and prop it back up.
correct.
And if we run out of things to do, we just look under our feet and dig more. We've got
Yeah, yeah,
unlimited resources under us, and it's
yeah,
it's basically been our get out of jail free card consistently for every
yeah.
single major market
Correct,
update.
man. And I may sound like I'm very, very bullish on the market, but I've been saying
Yeah,
for years, man, like these
I agree,
locations
100%.
above 1.3 mil, I wouldn't touch. I wouldn't touch. And we're seeing them decline today. Like we've had
Yeah,
clients come on the calls and literally asking about a few of these locations. Should I buy here? Should I buy an apartment or unit in this location? There's
yeah,
no chance you should.
no way.
You
Yeah,
won't do well. So like you can claim that I'm some kind of, very over optimistic bull in the property market. I'm very, very bullish on the right affordable locations, yes.
yeah,
But
yeah,
I'm just as bearish on the wrong unaffordable locations. I can guarantee you
yeah,
that. But we just don't deal with those situations today where we're putting our
yeah,
clients there. So we don't see the negatives there, but we're seeing those locations decline. So yes, I'll reinstate this fact that I can guarantee you this year, you'll see like 50% of the suburbs decline in value
yeah.
or the rate of growth significantly slow down. That will happen for sure. But the right locations and the right time of the market cycle, the right fundamentals, you'll get the growth. That's for sure as well.
Yeah, I agree with you. I think maybe at the worst, Melbourne and Sydney as a whole, maybe it will be
Yeah,
stagnant or go down.
yeah,
But I really can't see a place like Perth, Brisbane, or Adelaide, even being stagnant.
Yeah,
let alone
exactly.
going down.
Because again, the fundamentals are strong, and I think
Exactly.
like even in locations like Sydney and Melbourne, you might see on the headlines, -5% or flat growth or whatever that looks like at the end of the year. But I can guarantee you, there's suburbs doing 10% plus.
Yeah.
I can guarantee
Yeah.
we'll be buying there as well for sure. So that's
Yeah.
good.
And anywhere within half an hour of the city, you can easily find a $4 million home.
Yep,
And that's not unreasonable, which
exactly,
is the
man.
crazy.
Exactly. Yeah. No, we're not being overly optimistic, guys, but just keep in mind that, yeah, our forecast, like I definitely think that RBA will be forced to cut rates soon. And when that sentiment changes, for a lot of people, it might be too late.
Yeah.
It might just be because the prices will take off long before they actually cut the rates.
Yeah.
That the market
Yeah.
will price it in a lot, like months beforehand. So just be ready for when it does happen. I'm not saying it'll happen tomorrow, but in the next 12 months, there will be a point in time where that does happen. So it's just about making sure that you've got all the eggs in the basket, you've got the right conversations happening with the right people to get yourself ready to buy property. And obviously, if
Exactly.
you are buying property today, you have to be careful, buy in the right locations, do your research, do the due diligence, and you'll be fine.
Yeah. Exactly, man.
Awesome. I
Exactly. And the numbers
appreciate it,
speak for
man.
themselves, man. We haven't been wrong yet.
Yeah, 100%, man. We'll catch up soon. I appreciate your time today, Paul.
Of course, man. It's great. Always great to catch
Yeah.
up.
See you,
See you
man.
later, man.
Bye
Bye
bye.
bye.